Welcome. If you're new to the channel, my name is Matt Jimenez. I'm an entrepreneur who has worked with the greatest minds in finance over the last several years, and I'm here to pour into you guys everything they pour into me. And today I have one of those minds that I actually am referencing to on that intro, and his name is Joseph Brown. He is the founder of Heresy Financial, and he has probably my favorite financial YouTube channel out to date. And today I want to be going over a couple things with him because he has very interesting topics and perspectives revolved around the topic of finance, particularly. So welcome to the channel, Joe. This is your second time here, and really your face on the channel.
Yeah. Thank you for having me out again.
Awesome. So today I wanted to go over a couple of things, and the first thing I wanted to go over was a video you made about a week or two ago, and it was referencing the Bible, and more so different topics revolved around finance in the Bible. And the first thing that came to mind, because it's something that's very talked about, is the holy grail of investing. And you mentioned it in your video, Ray Dalio having about 12 investments is the ideal situation, but you actually pulled it even further than Ray Dalio and you brought it from the Bible. Can you touch on that and how the Bible actually tells us to have a diverse portfolio?
Yeah, absolutely. It's really funny because Ray Dalio calls it the holy grail of investing. And so it's funny that the kind of one of the oldest places where you can find that exact same advice is actually from the Bible, since he calls it the holy grail. And I don't even think he's aware that it's found in the Bible. But yeah, so basically the traditional advice when you talk to a financial advisor or anybody who's got like a very basic level of understanding about money, they talk about diversifying your investments, right? It's very basic concept. If you put all your eggs in one basket and you drop the basket, falls on the floor, your eggs crack, right? So don't put all your eggs in one basket, spread it around a bit. That way, if one thing fails, you still have most of your wealth left over. Now, today people take that, like, in my opinion, way too far. And they say, okay, well, if it's good to diversify a little bit, then it's the best to diversify the most possible. And they literally take their money, and this is what index investing is, they spread it out among every total investment possible. It's like, it's kind of ridiculous when you think about it, because to be an investor, a good investor, you have to be a good capital allocator. You're taking your capital that you've earned, that you created, and you're allocating it to somebody or a group of somebodies that you believe is going to do something really good with it and give you a return on the investment. So, like, why would you just mindlessly and blindly spread out your wealth among every single company possible when most of the returns in the market have always come from a very few number of companies? So you don't want to take this example too far. And Ray Dalio ran a very large study, a lot of money, doing a bunch of simulations among tons of different time frames in many different markets around the world, and found that in order to have true diversification, you don't need 1,000 companies. You don't need 500 companies like the S&P 500. If you invest in SPY, that's 500 different companies. You don't need that. What you really need is somewhere between 8 to 12 different assets. That's it. And the reason why you don't want to go past that is because then you start to have, not only do you have diminishing returns, you actually start to have decreased performance, because then, let's say you do have 500 different companies in your portfolio. One of them does really well. It doesn't make a dent. Like, it doesn't impact you, right? Similarly, if you have like two companies, one does really bad, you might lose 50% of your wealth. So that's a big deal. So the sweet spot there, which he calls the holy grail, that's like 8 to 12 different assets. And that's going to give you that sweet spot of, hey, if one does poorly, then, worst case scenario, you lose 10% of your portfolio, just about. And, you still have 90% left over. But if one does really well, you still have enough of an exposure to that one asset that if it does really well, it makes a huge impact on your portfolio. And the key there, though, like, it's not just about, let's say, 10 different stocks, because if you pick 10 stocks that are all like the 10 biggest stocks in the S&P 500, they're going to have really high correlation, which means they're going to go up together and they're going to go down together, which means, well, one does poorly, they're probably all going to do poorly. So the trick is, and this is the hard part, you have to find 8 to 12 different assets that are uncorrelated, which means they don't move up and down together. And all this was found all the way back in Solomon put this together. He was considered the richest and wisest man who ever lived. And this is, it's an ancient proverb that you have to make sure that your money, your wealth is spread out he says between 7 or even 8 different investments.
Wow, I really like that because whether people have read the Bible or not, it's still a wealth of wisdom. And for something to say along the lines of diversifying your portfolio in such a dated book with tons of wisdom, I find it really interesting. So that's why I wanted to hear your take on that. The other thing I wanted to talk about in regards to investing, and I want to hear your opinion here, does passive investing exist? Like, a lot of people are always out looking for a passive investment, thinking that there's a sit back approach to investing to where they could just allow money to accumulate in their bank account. And I mean, my opinion, I just don't think that it exists, but I would love to hear what you'd have to say on that.
Yeah, absolutely. So really, for the most part, anything that's going to be truly passive is usually going to be equal to or a little bit less than rate of inflation. So when you look at something that is truly passive income, you're going to be looking at something like putting your money in a bank account and just receiving the interest from the bank account. Most bank accounts today are well below the rate of inflation, but you can find a few, some high yield savings accounts or some money markets where those are going to be, right around the true rate of inflation. They say if inflation is like 3%, you can find some that are 5%. If you run the numbers, depending on where you live, the cost of living, the types of things that you buy, like for most people, your own rate of inflation is probably going to be a little bit closer to 5%. So passive income in terms of like real purchasing power, when you adjust for inflation, really doesn't exist. And the things that are considered passive income, when you look at what it takes to actually make real money from them, there's at least some work involved. And so it's really like kind of like a spectrum where the more you approach the passive side of things, the worse your returns are going to be, the worse that income is going to be. When you get more towards the side of the spectrum where it's like really, really, really active, then the better your returns are going to be. So we've gone over like the one side of the spectrum is like a bank account, and that's passive, but it's basically going to be the rate of inflation. So in terms of purchasing power, you're not really making any money. On the other side of the spectrum, I would put something like starting a business. Because in reality, capital allocation, that's all it is. It's like giving your money to somebody who's running a business. That's the only way to actually create profit and create wealth. So if you do that yourself, it's going to be the most amount of work. Like you're the one putting your time and your effort and your risk and, your blood, sweat, and tears and your sleepless nights, and you're the one building that business. Like all of the biggest fortunes throughout history have been made through starting a business. Like you can't get triple digit returns year over year over year over year through, a stock or, an asset like, precious metals or, anything like that. So that's going to happen from starting a business. Everything else is going to be somewhere in between. So when you look at the stock market, it's like, okay, are you going to approach this as passively as possible? You're going to get pretty okay returns. Like it's not hard to get market returns, your 8% a year. All you have to do is invest in the market. But that's not really that great considering the rate of inflation. Maybe you get, in real terms, like a 3%.
Can you talk about that for a second? The rate of inflation. You've brought it up twice now.
Yeah.
And now I want to say, like, okay, you prefaced inflation to be 5% in the previous thing you were talking about. So, but is that really the true rate of inflation? Is that really where we're sitting at? I would love to hear what you'd have to say on that.
It's actually actually impossible to know. And here's why. Number one, you have to measure something. You have to measure the price of something. So when you look at the CPI, they're measuring a basket of things. And the reason why they're measuring these things is because they just decide that these are probably reflective of the average American household. But when you look at the things in the basket and look at the way that they're measured, there's a couple weird things that stand out. So number one, there's something called the substitution method. So if, let's say, beef gets too expensive, people will start buying chicken instead because chicken's cheaper. This is just an example, So, some people won't, but a lot of people will. If that happens, then in the index, they will replace that beef with that chicken. Now, you might look at that and say, well, that is reflective of the average consumer's behavior, so we should be measuring what people are buying. But the index will now show something else that is cheaper in place of that. So the rate of inflation will not be reflecting the fact that beef prices went up so high that people stopped buying it. And so because behavior changes in response to prices, like if gas prices get too high, people stop driving as much, just a little bit, but they drive a little bit less. And then that stops the prices from going up because there's less demand for it now. So because the behavior changes, you can't actually measure what the total price increase is. What really you have to pay attention to is, how is my quality of life being impacted by the money printing? And that's why a long time ago, like 100 years ago, the word inflation meant how much the money supply had expanded by. Because any measurement of prices is inherently flawed. And it gives you a little bit of an idea about what's going on, but not enough to determine how much people's lives are being negatively impacted by the money printing. And so I do like to measure the money supply. Like, you can just look at M2 on the Fed's website. That's a measure of the money supply. But you can also just look at your own budget, and you can see, okay, like, how is my lifestyle? Am I buying the same things? Is it costing me more? Am I swapping things out? How is my income increasing compared to my expenses? And am I increasing my expenses just because I'm, being undisciplined with my personal finances? Or am I increasing my expenses because I'm making more income, and so my quality of life is actually increasing? So it takes a little bit more work, which gets back to like the idea of like passive income versus active income. But yeah, the rate of inflation itself really cannot be measured accurately because prices themselves change in relation to behavior changes as a result of those prices.
Yeah. So in summary, basically, people will substitute for a worse quality of life to meet their budget means because prices of things are too high. But then they measure it on that metric of lessening your quality of life. So you're saying that it just cannot be measured. But would you say that it's far higher than 5% at least? Could we at least?
For some people, definitely. So this kind of gets into like why I said you have to measure it for yourself, because it depends on the city that you're in. It depends on the costs that you have that are fixed. Like some people, have, family needs where their costs are fixed and they can't adjust their lifestyle. But for some people, certainly the true rate of inflation is higher. For some people, their true rate of inflation is probably much lower, and so it absolutely just depends, on every single person. And so I think on average, it's safe to say that the CPI undercuts the true rate of inflation over long periods of time by around 2 or 3%. I don't think it's as crazy as some of the private statistics show that, it's, double what is being reported, maybe during short periods of time, but on average over long periods of time, I think it's probably, 3 to 5% of a difference.
And I hate to make this about inflation, but I just keep thinking of inflation because the way we act and respond to how inflation happens, whether it's cuts or raises, we tend to adjust what we're going to do with our money, whether it's invest, borrow, etc. So we're at 5%. That's what it shows. Do you think we're headed higher, or are we going to hold here for a bit? And I don't want to make this all about inflation. I'm just really curious what you think.
This is something that I've been very wrong about in the past. And so take what I'm about to say with a huge grain of salt. But typically prices respond to a change in the money supply. And so back in April of 2022, the money supply peaked and it started moving down. And so my opinion was that we were going to see deflation, not just like the rate of inflation going lower, but like actual prices falling, which is, deflation. And the money supply continued to fall for about 1 year. The data is very delayed in when it gets released. And so it was about October of 2023, so like 4 months after the money supply had stopped shrinking, that I first noticed that the money supply was no longer shrinking. And so when I noticed that, I was like, okay, I was probably wrong about my deflation call, because yeah, the money supply decreased a little bit, but definitely not enough to tip us over into deflation. And it didn't continue decreasing from there. Now, the money supply has been increasing again for the last, 6 months or so, maybe a little bit longer. So liquidity is increasing. There's more bank lending happening. There's some tricks that the Fed and the Treasury are doing together to increase the amount of money that's in circulation, trying to replace some illiquid assets with more liquid assets. And so liquidity and the money supply, they are increasing again, which would indicate that inflation is here to stay. In addition to that, the longer term time horizon would indicate that inflation is going to be headed back up. We might see a little bit of a dip, but over the next 5-10 years, we're going to get a lot higher inflation, because there's no way the government can get out of what they're doing right now. They're spending without printing, and that pushes up prices.
Okay. Wow, that makes sense. So this is where I'm at. We're near the end of this, and there's two things that I really wanted to talk about, and I don't know which route we're going to take here. One of them being, you mentioned Bitcoin probably never becoming an actual form of money, and I want to talk about that because so many people are diehard thinking that it's going to be the next currency. But the other thing that I must talk about is the reality of becoming an active trader and or investor, and how it's a zero-sum game. Most likely, you probably would not become profitable trying to do this. And you've in your videos, and if you guys haven't seen his channel, it's a must subscribe. It's Joseph Brown, Heresy Financial. He talks about how if you lose 10%, you don't need 10% to get back to where you were to get break even. You need more than that. So that's why the whole game of trading is somewhat skewed against you. Let's go with the trading one first. What would you do to someone to advise them how they can overcome that, or whether they don't ever overcome it and they just let software do it for them?
Yeah, absolutely. So there's a couple of things. Like, number one, trading profitably requires making correct decisions. Like, that's it. Like, that's fundamentally what it comes down to, is it requires you to make a decision that is the correct one in the moment. Emotions make it very difficult to make the correct decision. And emotions are very strong when money and the potential for losses are on the line. This is why you see people like, I don't know how often you step foot in a casino, but I personally, like, I really hate gambling. But when I was 18 years old, I snuck into a casino with my buddy. I had $20. We went over to the roulette table, and 5 minutes later, my $20 is gone. And to me, like, that was like, I could have bought, like, what is that? Like 13 burritos at Taco Bell. I was like so pissed. I was like, I'm never stepping foot in a casino again. And which is probably really good, because if you get that win early on, then maybe you catch the addiction. But I was looking across from the table from me, and there was a guy there who looked really upset. And he, threw some stuff down and got up and walked away. And he just muttered under his breath, "I just lost 10 grand. And he had been there for like 3 hours, just continuing to go. And I think he even said he pulled out some money, like a dance line on his credit card. Anyway, the point is that emotions make it very difficult to make the correct decision when the potential for the loss of money is on the line. That's why people get sucked into these things where you lose money over and over again. And so the fact is, though, that in the market, you have some people who underperform, some people who outperform, and the average of all market participants total is something like 9% per year. That's the definition of what the average market return is. That's why people say just passively invest in the stock market, because you don't want to have to risk being on the underperforming side. Like you said, if you're on the underperforming side, you lose, $100. That's because somebody else was on the other side of that trade and they made that $100. But it's also true that there are people who are the outperformers. All of the market participants make up the total average. And so there are a couple of things that are very difficult to do, but you can use systems in order to remove that difficulty. And so you mentioned software. Even little steps towards that can be helpful. So number one, the only way you could possibly have a big loss investing is by having a little loss that turns into a big loss. If you always kill your baby losses before they're able to grow up and turn into adult losses, then you'll never have a big adult loss. So the idea is fall in love with taking very small losses, because then you'll never, ever, ever have the possibility of having a big loss. It's so important because, like, all of the best investors and traders throughout history say that the number one rule is don't lose money, never take a big loss. Risk management is the number one thing. It's all about losses. There's a million ways to make money, but there's only one way to go broke. And so never, ever, ever lose money. So you have to fall in love with taking small losses. Very easy way to do that. When you place a trade, immediately have a stop set so that if it goes down a specific small amount, you automatically get out. Will it go back up after that? Probably. Will that feel like it sucks? Probably. But guess what it might do? It might keep on going down, and it might have turned into a big loss. And if you lose 20% on one investment, you don't need a 20% gain to get back up to break even. You're now at 80, and you need to get back to 100. Guess what percentage that is to go from 80 to 100? That's a 25% increase. And this grows, that disparity between the gains and losses grows the bigger the loss. So if you get a 50% loss, guess how much you need to get back up to break even? 100%. Because if you go from 100 to 50, you need to get 50 to get back to 100, and 50 of 50 is 100%. And so the larger your losses, the more extreme, it's an exponential increase that you need on the gains just to get back up to break even. So eliminating losses is the number one powerful, most important rule that anybody can learn about investing. If that's the only thing you ever learn about investing, is never have a large loss. Always take small losses. And so there's some really simple things you can do to get there, whether it's watching attentively, whether it's just turning off your emotions and becoming a robot, whether it's using some of these preset orders and then backing away and letting it happen for you, or using some more advanced softwares that take off, more of that from you. And that's why the algorithms, and that's why the robots, and that's why they typically perform at least a little bit better, because they're not emotional. It's just, here's the rules, trade accordingly. And that's very hard for people to do. So either switch off your emotions, become a robot, start using tools, and you can move from the chronic loser side where they get these 80, 90, 100% losses and start increasing your returns.
Okay, I think we have enough time to stir the pot a little bit. And this is, I love like the most controversial takes, so probably a good thing to end with Bitcoin. Let's hear it. Why is it not ever going to have that network effect that people are waiting for? Currency, rather. Let me change my verbiage here, not network. Yeah.
There's two ways to look at this, and I think what you're referring to is what I've talked about just statistically. So there's something that people have, and I can't remember the first guy who's credited with noticing this effect, but it's called the Lindy Effect. The longer something, for certain things, the longer something exists, the more likely it will continue to exist for that much longer into the future. Like if you take a look at something like the sun, like our sun, it's a very durable thing. Like it's had everything that the universe can throw at it, and it still exists. Chances are it's going to exist far longer than anything that is alive on Earth today, because it has been alive or been there longer than anything on Earth today. Zooming in a little bit, let's look at the Great Pyramids versus the Eiffel Tower. If you had to put your money on one, you'd probably want to put your money on the Great Pyramids existing for longer than the Eiffel Tower, simply because, well, number one, it's made out of more durable materials that will oxidize, but number two, they've had more chances for the world and weather and climate and everything to throw stuff at it, wars and different rulers and regimes and cultures to throw stuff at it, and they still exist. Chances are they're going to exist far longer. Something like the Eiffel Tower is not as old, that maybe it is vulnerable to more shocks than the pyramids are. When you look at religions, something like Christianity has been around for 2,000 years. It will probably exist longer than something like Scientology. It has had more stuff to deal with. It's proven itself. It's more durable. And so that's called the Lindy Effect. It's basically the older something is, the higher the likelihood that thing will continue into the future. Obviously, this doesn't apply to anything with built-in entropy. So if you are like a human, like you're 99 years old, in all likelihood, you're going to be dead next. like the chances are you're definitely not going to survive another 100 years. In fact, the baby has more likely chance of surviving 100 years than the 99-year-old does. So it doesn't apply to that category of items. But when you take a look at something like money, what is money? Gold has existed and served the function of a store of value and as a medium of exchange for small purchases or even or large purchases for thousands of years. Now, the last 50 years, that trend has been disrupted. So the last 50 years, gold has served as a store of value, but its role as a medium of exchange has been reserved for very, very, very large transactions, mainly through nations and central banks. But outside of that, the last 4,000, but many people say potentially even like 6,000 years, gold has served the function of money uninterrupted. And so odds are statistically that will continue, because during that time, there have been many governments, there have been many cultures, there have been many languages, there have been many governments who have tried to come in and make fiat. The Chinese government tried to do it a long time ago. Central banks have tried to do it for thousands of years. You had the Roman Empire try to do that by diluting the coins, yet it still persists as the store of value and as the medium of exchange. So if you're going to place your money on it and say, if you could only pick one, which one would you store your value in for the next 1,000 years? then statistically you'd be much better off placing that bet on gold. That doesn't mean that something can't come in and disrupt that. Based on the properties that made gold good money, like based on the properties that made the Great Pyramid very durable, if somebody came along and built a new Great Pyramid out of the exact same materials, with the exact same methods, the exact same size, but the only difference was they looked at the weaknesses that the Great Pyramid had and tried to improve it. So maybe it was like the weakness was it was near civilization. And so it had people come in and take off the outer stones and use it for other building. So maybe they build it somewhere where people are not, civilization is not there. Then you could make a bet that that would exist longer because it was built on that. And so that's kind of how I view Bitcoin. It's like, it's built with a lot of the same properties that made gold good money. And there is a bet that the differences are make it stronger than gold. And that's certainly a bet worth taking, in my opinion, with a small percentage of your portfolio, because we don't actually have to pick. You don't have to pick gold, or you don't have to pick stocks or dollars, or like you can pick a couple. You can add 8 to 12 uncorrelated assets, right, in your portfolio, just like we talked about at the beginning. And so if you put 5% or 10% of your portfolio in Bitcoin, the worst case scenario is you lose 5% or 10% of your portfolio. But the best case scenario is if it becomes universally used as a store of value and a medium of exchange later on in the future, the market cap will have to be much, 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 much larger than it is right now to accommodate global transaction values on a daily and yearly basis, which means you have an asymmetric trade in front of you. The value that it could go up is much higher than the value that it could go down. And so I think it's worth allocating a small percentage. Is it likely that it goes there? I don't think it's as likely as it going to zero, but I think it's likely enough that it's worth buying something.
Okay. Good thing I have some left. I haven't used it all for transactions.
Right.
Well, that's everything I wanted to cover here today. Can you give a quick 1-2 on where the people can find you if they want to see more on your takes on finance?
Yeah. One place only, YouTube. My channel is Heresy Financial. We do 1 or 2 videos a week where we talk about the economy, markets, money supply, talk about investing and trading, anything you need to know about growing your wealth, protecting your wealth, we're going to find it there. So Heresy Financial on YouTube. And if you want more, I'm always talking about other ways to do it through YouTube.
Yeah. And he also has a great community too. So if you're looking for finance people around you, like-minded with the same goals, he has Heresy Financial, which is soon to be a university. Yeah,
Heresy Financial University, my private membership group, where we have a whole entire library of training material, community, trading alerts, reports that get sent out on asymmetric opportunities, and a bunch more coming down the road.
Nice. Well, awesome. Thank you again for joining for the second time. And maybe there'll be a third time in the future, but I appreciate your time, Joe.
Yeah, thanks again for having me.
All right. Thank you.